So I think every country wants to know what the other country's situation is looking like and what we can learn from the experiences of other countries. If you think about an ordinary citizen or a common public, debt is really ingrained in the psyche. And it's, if I may say in Hindi, it's कर्ज चुकाना है. In practice, if you think about it, you are generally rewarded only for exports. Exports are important, and you get reward, you get pat on the back.
Hello everyone, welcome to Arth Niti. I'm Shekhar Tomar. We are extremely happy to have Prachi Mishra with us today. She is currently the Chief of Systemic Issues Division at the International Monetary Fund. Prior to joining the IMF, she obtained a PhD from Columbia University. Her research interests are on the intersection of international trade, political economy, banking and finance. Prachi has very wide experience both in the private and public institutions. Prachi was the head of the Strategic Research Unit at the Reserve Bank of India. She also served in the Prime Minister's Economic Advisory Council. She was also in the Economic Advisory Committee for the 15th Finance Commission. In addition to that, Prachi was also the Chief India Economist at the Goldman Sachs. Prachi also obtained the Mahalanobis Memorial Award in 2018 for her outstanding work in economic research. And finally, thank you for being here, Prachi, so much. Welcome to Arth Niti.
My pleasure, Shekhar.
So, Prachi, for us outsiders, IMF, the International Monetary Fund, is like a black box. So maybe you can tell us what IMF does, given your vast experience and the different divisions that you've worked in.
So, Shekhar, very broadly speaking, big picture, the International Monetary Fund's goal is to foster international financial stability. And we do three main things. One is we give policy advice to countries, as you can guess. So we are constantly monitoring economic and financial development in countries. And based on that, we give advice to countries. Second, again, as you can guess, we do a lot of financial assistance and different kinds of loan programs. And third, we do a massive amount of technical assistance to countries around the world. For example, in Delhi also, there's a SARTAC, there's in Africa. In many parts of the world, we have technical assistance centers, which cater to building capacity globally in many different areas in international macroeconomics, banking, and finance. Let me come to my division, which is called the Systemic Issues Division. It's part of the research group at the IMF. Here we do three things. One, we do a lot of thinking on sovereign debt. For example, we did a recent World Economic Outlook chapter on globally high levels of public debt and how can countries address that. Second, we do something called the Integrated Policy Framework. It's a new analytical approach for dealing with fluctuations in international capital flows. And third, we deal with a number of issues which are currently systemic. Think about inflation, global supply chains, or we also do a review of systemic economies like Argentina.
Following on this, so what kind of advisory and technical role does IMF play? Because I guess for poorer or less developed economies, they might depend just on the IMF for this expertise. But is there a role like across the board that everyone cares about?
So, Shekhar, I think what the IMF brings is a cross-country global perspective, and particularly on macroeconomic and financial sector issues, which all countries care about. IMF has about 190 member countries. Just to give you a concrete example, for example, as I said in the World Economic Outlook, recent World Economic Outlook, we did a chapter on global public debt. So I think every country wants to know what the other country's situation is looking like and what we can learn from the experiences of other countries.
So this is like benchmarking and then...
Yeah, I don't want to say benchmarking, but at least learning about, for example, the chapter on public debt looks at debt restructuring. So it's very important for every country who's thinking of, or even not thinking of, but thinking of the problem of high public debt, what kind of conditions made it possible for some of the other countries which did restructure their debt, or even countries which dealt with high public debt by doing fiscal consolidation. Under what conditions can fiscal consolidation work? Under what conditions can fiscal consolidation not work? I think so. What I think the IMF brings is a global and a cross-country perspective, which is, I think, very rare across the organization. And in our experience, countries value a lot.
And is there like some increased competition? Because we see a lot of these international organizations are now coming up, which might try to fill in the role that only IMF used to do, let's say, 2 decades ago.
Right. I would say that different organizations are complementary. And again, what the IMF brings is a more global perspective, cross-cutting across different regions.
Okay. So following on this, so I know that you also worked on the FRBM committee report in 2017, and you already talked about sovereign debt. So maybe you can give us a sense of what are we talking about here? What is public debt? Why should we care about it?
So let me say that, yes, indeed, I was the de facto secretary of the FRBM committee back in 2017. I think after a lot of extensive consultations, the committee decided on moving to public debt to GDP as an anchor of fiscal policy. And there were 4 reasons which formed the basis of the decision of the committee. Number one, if you look at standard models, public debt is the objective of fiscal policy in terms of standard government solvency constraints. Second, I think the committee thought that public debt combined with fiscal policy, fiscal deficit could form a robust framework jointly. Third, I think public debt to GDP in India at that point and even now remains high relative to a peer group. And finally, if you look at credit rating agencies, I think they do care about public debt as well. So these 4 reasons were the economic arguments for why the committee decided to move to public debt as an anchor of fiscal policy. But I should also point out that there was a very interesting non-economic argument for using public debt, and that was basically that if you think about an ordinary citizen or a common public, debt is really ingrained in the psyche, and it's if I may say in Hindi, it's qarz chukana hai. So there was a very powerful non-economic argument, and the idea that this concept could be communicated to the public for choosing public debt to GDP as an anchor of fiscal policy combined with fiscal deficit as an operational target.
So this is more like philosophical and moral fabric of the Indian society also cares about it.
That was indeed one of the non-economic arguments for choosing public debt. And let me also point out very quickly, Shekhar, that my current research, I've looked at another cost of high public debt, which is debt service burden. So if you look at interest payments to revenues for an average emerging market and compare it to India, India is about 3 times an average emerging market. And what does all this mean is...
So just to get context, like in case of India, it's like out of 1 rupee they spend, it's 30 paisa which is going for servicing the debt. And you're saying for other economies, it would be like similar peer, like India, it would be 10 paisa.
That's correct, Shekhar.
Okay. And what are the costs for this? Like, how should I think about this?
So there are 2 costs of high debt service payment. One is, when you actually need to do countercyclical fiscal policy, there's limited space because your resources are actually allocated to making the interest.
So by countercyclical, you mean that when the economy is doing well, you want the government to come in and spend?
The other way around. So countercyclical, you mean that when the economy is not doing well,
then the economy is not doing well.
Then you actually want the government to spend. When the economy is doing well, you want the government to save. So you save in good times and you spend in bad time. But if you have high interest payments, that restricts your capacity to do fiscal policy when you act countercyclical fiscal policy when you actually need it. And again, a slightly technical point related to this is if you look at variations in debt in India compared to other emerging economies, India is less related to cyclical fluctuations than peers.
Okay.
And the second cost of high public debt I should highlight is, which is more natural for developing economy. If you're making high interest payments, you have less resources to allocate to areas such as health, education, now green transition. And in a recent paper, I did some calculations on if you, for example, if you were able to bring the interest payments to revenues from India's current level to an average EM, you would be releasing something like 6 to 8 lakh crores, which could be spent on health, education, and other, which is almost like if you look at pre-COVID levels.
So 6 to 8 lakh crores would be like
So
1-2% of GDP.
Yeah, more, 2.5. So compare pre-COVID levels. I think if you compare it as much as the education expenditure, double the health expenditure which India makes currently.
So just picking on that, so you said cyclical spending by India is almost flat, and that's because they don't have space to spend during bad times. They're always spending very high.
Right. I think if you look at the variation in debt, as you know, we
Okay.
look at variation in debt. How much is explained by cyclical fluctuations?
Okay.
It's very less in India compared
Okay.
to an average emerging economy.
And then, like, just building on it. So during the COVID period, I guess you analyzed it for like all the countries that you are tracking. In terms of spending, like where would India stand relative to others? Because I guess most of the developing economies probably had less space to spend during COVID. The governments, I mean.
Right. I think if you look at fiscal support during COVID, I think the advanced economies did much more. It went, especially if you include above the line and below the line. Below the line are these liquidity measures. Advanced economies did way more than typical emerging economies.
And so I just want to trace this history of FRBM. So I guess the first law passed in 2003. And because you were on the advisory committee, maybe you know, like, what's the history of it? Like, are we constantly tracking it? And what is it that we do new every time there is a committee talking about this kind of budget responsibility by the government?
Since 2000, original FRBM came into picture. And if you look at the fiscal position in India, it improved dramatically after the FRBM, and then it was reviewed because I think the global environment has changed, right? I think it's it's a totally different global environment, especially after 2013 mini taper tantrum crisis, which happened especially for emerging economies, including India. So it was time to revisit the framework and think about the goalposts. I think now probably with COVID we are in totally different environment, and I'm sure there will be rethinking on the framework going forward.
So in the latest one that you helped prepare, what's the optimal level of debt they are targeting for India, debt to GDP?
So at that time, again, after a lot of cross-country evidence and using a lot of technical methods, the committee came up to a number of about 60% of GDP. And of course, in the context of COVID, the goalpost will have to be revisited and seen how it fits.
So now we are at 90%.
We are between 80 to 85, I think.
Okay.
India is somewhere between 80 to 85, which is still higher compared to emerging market countries. But you're right that post-COVID, it went above 90% of GDP.
Okay, I see.
And then came down with, as GDP growth picked up, inflation was high, you have declining debt to GDP from its peak post-COVID levels.
So following on this further and just trying to understand, maybe you can unpack some of these technicalities for us. How do you decide that it should be 60% for India?
Yeah, I think, again, there are a number of approaches we used to see what the optimal debt to GDP is. For example, how much, if you're put in a stress scenario, how much a country can withstand. But in addition to that, what is the level of debt beyond which some of the non-linearities in terms of the impact on growth set in. So there were a number of methods that were used. I think another method was that look at peers and see what their averages, and that was also a key input. So I think it was, as much as I can recall, I think it was a combination of different methods, and again, a lot of consultation externally, internally to come up with a 60%. And as I said, post-COVID, a lot has changed, and that's what the World Economic Outlook chapter looks at. Globally, public debt is at unprecedented levels. And how to bring it down is a challenge across the world. And how fiscal consolidation works, how debt restructuring could complement it. I think you have to think about it in a holistic way in this post-COVID environment. So any of the goalposts, I think, which countries had in the pre-COVID era would definitely need to be revisited. And you would have to look at additional. So I think in the new thinking, it's not only debt, but I think things like government bond spreads. How much government is borrowing at in relation to a risk-free rate. So you have to take into account additional indicators as well.
And the 60% number that you gave was for the center government or for including states?
No, it was at that point, it was 60% center plus states, so 40% for the center and 20% for the states. And the idea was that you would be able to bring it down or at least bring it in the direction of declining debt trajectory from, I think it was above 50% for the center at that point of time and about 25% for the states combined. The idea was that both would be in that trajectory of declining debt to GDP ratios.
And was there also recommendation on how the state government should do it? Because I guess that was kind of a black box. Even going 5 years ago, it's difficult to track what their debt is. So were there any targets for them specifically to achieve and how they are doing?
Not state by state. I think it was because I think the framework was overall for the sovereign. And so what matters is, in the end, what matters is sovereign debt to GDP. So I think the FRBM committee focused on center and states as combined altogether. I think it was in the mandate of the Finance Commission to look at particular states and the dynamics between states and look at vertical devolution and horizontal devolution.
So since you talked about spread, I guess different states would also have like different paying capacity. And last time I tracked these numbers, each state was paying same interest rate, roughly same, like there's very small marginal difference between the states. Do you think that should change, that states which are doing well on monitoring the debt, they should be able to borrow cheaply? Was that also something which was discussed?
So this has been one of the stylized facts of borrowing by states. That is, markets don't tend to distinguish across different states depending on the fiscal discipline across or variation in fiscal discipline across the states.
So, but just to put in context, in the US it would be different across states.
I am not sure. I have not looked at state level spreads for the US. For India, we did look at it for the FRBM.
So I know in the US, even the cities borrow, and there can be a large variation in terms of what cities pay.
Right.
So yeah, I'm just guessing it would be the same for states.
Right. Yeah, that's correct. And I think, so this was one of the big issues discussed in the FRBM and also in the 15th Finance Commission. That is why is there not variation across states? And I think there are two reasons. One is I think the liquidity of these markets is not very high. And second, I think the information about these state development loans or SDLs is also not that all pervasive. So if you ask a foreign investor about these state development loans, it's the knowledge about the markets, the conditions which are needed, the requirements of investing in state is very sparse, I would say. So it's a combination of both liquidity and information related factors that would be responsible for very flat borrowing rates across spreads, despite differences in a lot of state level variables, including fiscal discipline.
And the 15th Finance Commission, I guess they also looked at it. And I mean, for outsiders, again, it's kind of black box.
Right.
What does a Finance Commission really do?
Right. So the Finance Commission, I think, looks into vertical devolution and horizontal devolution. So vertical devolution is how much, so if you have a pot of resources, how much is allocated between the center and the states? And given the overall allocation of the states, how do you distribute across different states, which is called horizontal devolution. So if you think about it, the level of development of a state is a function of a very complex set of factors. It includes, for example, historical factors, cultural factors, socio-economic factors. So the idea is that you could give additional resources to a state. However, these additional resources it depends on how these additional resources are actually being utilized, whether they're being utilized effectively. So what the 15th Finance Commission did was to reward, to allocate horizontally based on need, but also based on performance. And the idea for allocating resources across states for performance, based on performance, was twofold. One was you want to incentivize better performance going forward, and the second is you want to reward past performance, which included which included states which can actually utilize these funds more effectively.
So one of the most common thing we only hear about Finance Commission is that you're going to provide these resources based on the population. So I don't know how heated these debates were in the committee?
Right. So demographic performance is one of the criteria which the Finance Commission uses. So what is demographic? So this is one of the performance criteria. So whether you reward states which perform better based on population control, but more generally on health and education indicators.
So just to provide context, so the idea is that because UP and Bihar, they have like large or sharp population growth, historically they would have received more funds. And now there would be like some penalty associated with it because they grew so fast.
Yeah, because I think the allocation based on demographic performance was about 12.5%. So states which did better on population control, but also, as I said, more broadly on health and education indicators would get a little bit more based on population performance.
So this is a difficult question, right? There is some moral hazard,
right?
But also there would be problem of convergence because these states are poor to start with, and probably they'll get less support.
Yeah.
So how do you balance these objectives?
Absolutely. I think this is the delicate balancing act which the Finance Commission tries to perform is, balance needs, because I think you want to allocate resources based on needs, but at the same time give some weight to performance as well.
Okay. And the performance was 12.5%.
Demographic performance was 12.5%.
Okay, I see. So I'll move to the other part. Like you've also spent like a lot of time at the IMF, but also at the RBI. So you have tracked monetary policy, not just in India, but also in other countries. So I'm just quoting from one of your articles with Rajan. You say that all monetary policies have external spillover effects. The bottom line is that simply because a policy is called monetary, unconventional or otherwise, it may not be beneficial or net for the world. That all monetary policies have external spillovers does not mean that they are all justified. So what spillover are we talking about over here?
So indeed, Shekhar, I think spillovers has been a part of my research agenda over the last decade. And if I give you some historical perspective, on May 22nd, 2013, almost a decade ago, the then Fed chairman, Ben Bernanke, indicated that the Fed would start tapering of its asset purchases. And of course, emerging markets reacted very sharply to even an indication of tapering of asset purchases somewhere in the future. I think I had the opportunity to be a part of an Indian G20 delegation to Russia at that point. And emerging markets had made the point that, look, while on the one hand, aggressive monetary easing in the core countries, which included US, Europe, and Japan, could support recovery in these countries and in turn increase the demand for exports from emerging markets. At the same time, there could be other spillovers as well. Think about widening interest differentials, increasing capital flows, and exchange rate appreciation. And importantly, when you withdraw or anticipate, or even anticipate withdrawal of some of these asset purchases, there could be a host of other risks as well. So I think my current research agenda on spillovers have focused on three things. One is, there was a paper which I worked on a couple of years ago, where we looked at how markets differentiate across countries when there's, in the case of any adverse shock, or in case of any shock. And what we found is that countries with better macroeconomic fundamentals, lower current account deficit, lower fiscal deficit, lower inflation and higher GDP growth, and deeper financial markets actually react less when there is an adverse shock. The second part of the research, which I'm actually working on now, is to look at monetary policies in the core countries and US financial conditions in particular, and look at spillovers at a very microeconomic level. So we look at basically mergers and acquisitions around the world in response to changes in US financial conditions. So for example, when US financial conditions get loose, how do mergers and acquisitions behave? And we find that mergers and acquisitions go up. But very interestingly, what we find is that they go up even more if you are a country which has a lot of foreign currency denominated debt. So what is the mechanism here? So basically what happens is when US financial conditions loosen, local currency actually appreciates. So there's a net worth channel and net worth of corporations and countries which have a high degree of FX denominated debt that actually goes up.
So and this is both corporate debt or government debt if they own foreign. Right. In both cases, it goes up, or only corporate debt?
I think our primary measure which comes from the IMF, actually looks at overall. So if you're a country which is overall more indebted in FX. But I think using BIS data, we can distinguish across. We don't have very detailed data on particular corporations, but I think I think the M&A channel would mostly apply through corporations. And so if you're a country where corporations hold a lot of FX denominated debt, US financial conditions loosen, local currency appreciates, your net worth would go up, and there would be even more mergers and acquisitions. So this is my second.
But this is interesting. Generally, you would think that if you have like too much foreign debt or US dollar denominated debt, you might be negatively impacted more. So on the downside risk is higher, and the upside risk or upside benefit, we don't know. But in this case, you are saying that the upside benefits are much higher for these countries.
So basically, and the mechanism is through the exchange rate. So when US financial conditions loosen, or there's a lot of liquidity in the US markets, what happens is the local currency for an emerging market like India or Brazil, that actually appreciates. So, and if you have a lot of FX denominated debt, that debt, you get a net worth boost because your debt in local currency actually goes down. So, and that helps you make even more mergers and acquisitions.
And so, because you're tracking the World Economic Outlook, so now the transmission would be on the other side, which is that the Fed is increasing the rate.
Right.
Like, what are the risks for the rest of the world because of this kind of spillover now?
Right. So I think, as I mentioned, I think if the Fed is increasing rates, or back in 2013 when there was anticipation of tapering of asset purchases, basically it means capital outflows. In principle, it means capital outflows from emerging economies to the advanced economies, and that could be associated with depreciation pressures, and while on the one hand you can think that this can increase export competitiveness, etc. But I think if you have a lot of FX denominated debt, the value of that debt is actually going to go up, and that's going to negatively impact. So this is exactly, I think, if you go back to 2013. I think what exactly happened during the taper tantrum. But I think importantly, it's important to remember that countries with better macroeconomic fundamentals are affected less when there is an adverse shock like this.
And is it better than 2013? Because 2013 was like completely unanticipated. And because we lived through it, now everyone knows what to do probably. But is the shock like of similar magnitude, or it's less impactful this time? So if I have to make a comparison, 2013 was really unanticipated and people lived through it. So now we have better sense of how to deal with these shocks. So if you have to compare now the Fed increasing the interest rate, how would you compare it relative to 2013?
I think the quantum of interest rate increase is unprecedented this time around. So you are right. I think that a lot has been priced in by the markets, but there are a lot of unintended consequences for the impact on banks, what the unrealized losses are, and so on and so forth.
And does IMF have like a specific position on it? That I know they can't tell the Fed, but there should be still discussions about it, that there's an optimal way to do it.
Right. Yeah, I think there is no optimal. There's nothing optimal, and there's no.
Okay.
I mean, it should be it should be forward guidance, etc.,
okay,
which is properly given. But this time around, everything is priced in. Huh? It's in the sense that what happened to the banks was despite the fact that there was no shock in the sense, right? We knew that there is this much quantum of interest rate increase which is built in.
Coming to the Indian context, though, I mean, there's a lot of work now about monetary policy transmission. And I remember you had a paper on it talking about that banks probably don't transmit the changes by the RBI immediately. What was interesting about it was you were looking at like how banks or even a given bank is transmitting it across different cities. So maybe you can tell us about why it's important and what did you find?
So this is one strand of research where we used branch level data and from the basic statistical returns of the Reserve Bank of India. And the idea was that if you look at the literature, it focuses on bank level, as you mentioned yourself, Shekhar, and it looks at external frictions of banks. If you're a bank which is more constrained to go to markets to raise funds, etc., you have bigger transmission of a monetary policy. For example, classic work by Kashyap and Stein, etc. Here, we, instead of looking at frictions across banks, external frictions of banks, we look at internal frictions within banks across branches. And why is that important? Actually, if you look at variation in credit, 90% of the variation in credit in India is actually within banks across branches than across banks. And this is what actually motivated this whole
So this is like SBI, if I think of just as an example.
Right.
Across SBI branches, there's more variation than between SBI and, let's say, Axis Bank.
Correct. Absolutely correct. So 90%, if you do a standard, again, to get a little bit technical, if you do a standard variance decomposition, 90% of the variation in lending is actually within banks across branches than across banks. So this is what motivated the entire exercise. And basically, we did two things. One is we looked at changes in reserve requirements as a policy tool, which is used fairly commonly across emerging markets. And it's a very direct tool of policy. And number two, we looked at, as I said, within banks and across branches. And one of the key findings was that branches which have more more friction within, so greater the friction within branches, lesser is the transmission of changes in reserve requirements. And again, to say it in a more non-technical way, suppose there are branches which have more expertise, branches with more number of officers, and those which make sort of less complex loan structures, they actually transmitted faster changes in reserve requirements than compared to other branches.
And if I have to think in terms of geographies, are the metros doing better than non-metros? Like, where is the slowest transmission?
Right. I think we looked at rural versus urban. In the latest version of the paper, we focus mostly on intra-bank organizational frictions. But I think we did find that rural areas tend to transmit less compared to urban areas.
And is it also like state level variation?
No, we actually, because it's within banks across branches, and branches are at more granular level, we did not look at state level variation.
Okay. And would there be also like some time trend, like at some points of time this gap reduces and then other points it widens?
So we looked at loosening versus tightening, and we did find differences in the rate of transmission. I think we found it greater during loosening times than during tightening.
So loosening would be when RBI is
loosening would be when you're reducing reserve requirements. These are times of loosening of monetary policy.
And in terms of comparison, are there any similar studies in other parts of the world which also look at like bank level transmission? Are they similar, or India is like very different relative to them?
Right. I think there is not much of a trend to look at branch level data. I think there is some in the United States, but mostly focusing on deposits rather than credit.
But is there any policy prescription from it? Because okay, I'll move to like another strand of your work. Your PhD dissertation was mostly on trade. So let me ask you the question, which is your favorite trade model and why?
It's a very good question, Shekhar. I think my favorite trade model would definitely be models of comparative advantage, like Show Lane, Ricardian. And if you think about it, Paul Samuelson, for example, was asked by one of the big mathematicians, can you tell me one principle in all social sciences which is true but is non-trivial? So it's true, but it's not obvious. And actually, Paul Samuelson did not have an answer very quickly on this question. He actually thought about it for many years, and he said the answer is comparative advantage. So maybe for a non-technical audience or a non-trade audience, what is comparative advantage? Okay. Let me give you an example. Let's say that there are two countries, India and Brazil, and there are two commodities, sugar and pharma. Let's take sugar. India can produce 1 unit of sugar with 3 units of labor, and Brazil can produce 1 unit of sugar with 10 units of labor. Let's look at pharma. India can produce 1 unit of pharma with 2 units of labor, and Brazil can produce 1 unit of pharma with 10 units of labor.
So it's
So the
3:10 and 2:10.
Yeah, so the relative productivity advantage of India is much bigger in pharma than it is in sugar. And it is vice versa for Brazil. So the trick to understand here is India has absolute advantage in both these commodities.
Because they only take 2 hours and 3 hours.
Correct.
And Brazil take 10.
Correct,
Okay.
correct. And the trick is to, you specialize in commodities where you're more better at or less worse at. So Brazil and India can still gain from trade and specialization.
So in an absolute world, because India is good at everything, you wouldn't trade. But here, the comparative advantage is telling us that there's still gains.
Exactly. And this is what I think a trade economist can convey to a non-trade or a more general audience. And it's a very powerful intuition. It's simple, but I think once you understand it, it's very intuitive, but it's very powerful at the same time. Let me give you another example, I think, which we can relate to. I think about Shah Rukh Khan, right? He's a Bollywood actor, but we also know that he has an econ degree. Let's say for a minute
he has an econ degree? Okay,
yes,
I didn't know that.
He has an econ degree. And let's say Shah Rukh Khan were the best economist in the world. But his opportunity cost of doing economics rather than Bollywood is probably crores and crores of rupees, right? So I think this is the power and intuition of the principle of comparative advantage. That is, you specialize in commodities where the opportunity cost is the minimum, right? In practice, if you think about it, you are generally rewarded only for exports. Exports are important, and you get reward, you get pat on the back. I think trade economists can tell the world that, look, successful exporters are also successful importers, and this is where this is even more true in this world of global value, increased global value chains as well.
So following it on to the practical side of things. So I know you had like a paper looking at Indian exports in 2018. And you looked at the entire basket of exports from India. So what are the key findings from there?
Let me say 3 things. One, against common perception, India is actually relatively open. So India's export to GDP is about 20% or so. And for a large economy like India, this is a big number, and it's comparable to, say, Indonesia.
So I guess it's a bit lower now because it's 500 billion to a $3 trillion economy.
Right. So there was slowdown in exports, and there were a number of factors responsible for that. But let me just let me here point out that there's a difference, Shekhar, between merchandise versus overall. Okay. So the second finding in this paper was there's been a revolution in India's exports. So one is merchandise exports or manufacturing exports themselves have moved away from standard goods like textiles, gems, and jewelry to more new age electronics, electrical goods. And the other revolution has been from manufacturing towards services. And here, I think the other finding from this strand of work was against common perception, India is not insulated from global shocks. So the partner country income elasticity is very, very high. So when there is changes in partner country income, India does get affected. And finally, I think, let me point out, we looked at exchange rates as well. And this was using firm level data. On average, exchange rate doesn't seem to have a very statistically significant effect on exports. There's very interesting variation across sectors. It depends on whether you are a sector which is intensive in imported intermediate inputs or not intensive. So consider a sector like textile versus consider a sector like pharmaceuticals. So textiles is relatively less imported intermediate input intensive compared to, say, pharma. Pharma is very high imported intermediate input intensive. So and this matters for the effects of exchange rate. So if for example, if the exchange rate depreciates, if you're a sector like pharma, your imported intermediates get way more expensive compared to a sector like textiles. So you have less of a kick from depreciation to competitiveness if you are a sector like pharma compared to a sector like textiles. So if you are high domestic value added sector like textiles, you still have standard mechanisms from exchange rate to competitiveness working compared to a sector where you're very high foreign value added like pharma.
So just to rephrase it, and I'll ask questions on each of these points. So the third exchange rate point that you mentioned is because the Indian basket has become such that now it has a lot of imported inputs, exchange rate depreciation does not help so much in terms of gaining exports.
Right. So there's, again, at any point in time, there's variation across sectors. But I think you can use it, as rightly you did, you can use it to explain variations over time as well.
So on average, India has moved to sectors where this help from the exchange rate depreciation is not so high.
Correct. To the extent that it is becoming more important in intermediate input intensive, which is true generally with global value chains increasing. You will also have a mechanism from changes in exchange rate to cost of intermediate inputs as well, which are imported.
I'll go to the first question or the first point that you mentioned about that. On average, our exports are much higher relative to GDP. And you use that metric to say that India is probably not that protected. But that's an outcome variable. Like if you look the same thing on the tariff side, can you say the same? Because maybe it's possible that if the tariffs were reduced further, maybe it wouldn't be 20%, but 25%. So in terms of tariff, where are we, like relatively speaking?
Right. But ultimately, you care about de facto outcomes, right? In the end, what is the outcome, right? Trade openness, I think, is measured by export plus imports by GDP, rather than de jure or policy. So to me, I think an indicator is trade to GDP, which is a standard measure of openness, and there India appears relatively open compared to peers.
So this paper was written in 2018. I guess a lot has changed since the COVID pandemic. So maybe if you can talk about, I know you might not be working on it right now, but what are the general trends in the world and maybe even for India after COVID in terms of exports and imports?
So I've been looking at more globally what's happening to trade after COVID, and one stylized fact is that trade has shown remarkable resilience in the aftermath of COVID. So trade, there was a collapse in trade, but very quick recovery. And so first we thought that it's all driven by income. Actually, when we look at trade to income as well, there is there is a very steep slowdown, but very sharp recovery as well. So trade is even trade to income is back to pre-pandemic levels. And we are trying to disentangle it and look at it, whether it's quantity, whether it's price. So it looks like it looks as if, for example, if you look at the United States, it looks as if quantities have recovered, trade quantities have recovered to pre-COVID levels, but prices have shot up even more. And domestic prices, in fact, have shot up even more, and we are trying to understand some of what is driving some of these dynamics.
And if I may build on this further, there are a lot of free trade agreements that India is trying to negotiate right now. And given that GVCs are also the flavor of the town these days, how do these two things tie together? The kind of FTAs we are seeing, the negotiations about them, and the role of GVCs. Are the FTAs really coming up because of the GVC nature of trade now?
So I have not looked at it more analytically as yet, but I think there is this tension between regionalism versus multilateralism, and there's work done by one of my thesis supervisors, actually, Jagdish Bhagwati, who said that this is these bilateral trade agreements are like a spaghetti bowl. So I think ultimately we have to keep in mind the multilateral perspective. And I think at the margin, of course, free trade agreements can boost trade, but remember that there can also be, there's a literature which shows that there's trade creation, but there's also trade diversion from these trade agreements. So we have to keep the multilateral perspective in mind.
So last question. You have been straddling between India and US, and you've worked at so many institutes. Which one is your favorite? You don't have to answer it, but if you have to give a pecking order.
I'm not sure if I can give a pecking order, but I think it's been, I've been very privileged to have worked in a number of large institutions, and each one of them has been a fascinating and a tremendous experience. And I love my current job at the IMF.
So because you worked at the RBI for a while, if you can give us some insights, how did you find working at the Reserve Bank of India?
It was really a fantastic experience. I think it's an amazing organization with extremely high quality, very talented staff. So I feel very privileged to have been associated with the Reserve Bank of India. And it has really widened my perspective, policy and also research, and the intersection between the two.
And then you also worked at Goldman. So that's like completely different space. I guess the speed of working is like very different. How did you find that? It's
a different job and it's a different audience. So you have to make yourself flexible and adaptable to use your skill. The skills are ultimately the same, right? I'm an economist by training, and I work at the intersection of policy and research. So the skills are the same. It's just that the audience is different and the style is different. So it's very, mostly, communication is also different. So the packaging is different, the communication is different, but ultimately the skills are the same. You're an economist, and I think you have to strive every day to innovate, bring new perspectives to the questions at hand. And this is the policy, basically. This has been my philosophy, to work on questions which are important and which are central to both global economic policy as well as to society. And then you use the best tools available to address that question.
So the underlying questions remain similar, but then you work at different organizations, and that's how it works.
Right. And you have to be adaptable and flexible to be able to cater to the audience and to the demands of the organization.
Wonderful. It was great talking to you, Prachi.
Thank you. Thank you very
so
much,
for your
Shekhar.
time.
It was a pleasure.